Welcome to Money Discourse, another crazy week. Man, I can't just wait for the regular weeks like we used to have in the good old days. So, the pound getting trash, flash crashes, Bank of England interventions, Tesla bot, and delivery numbers. We've got a packed show for you today. Rajan, why don't you take it away?
Well, as you mentioned, the week has not been short of volatility. We were looking at just another real stinker of a week on Monday, Tuesday, until the Bank of England came in and said that it was going to be buying back bonds. And this goes against, we see the UK government providing the stimulus through this tax cut. And then you've got the Bank of England trying to raise rates to push down inflation. Then through these tax cuts, these gilt yields go wild. And then what does the Bank of England have to do? They have to reverse course on what their mandate is to try to reduce inflation. They had to go buy long-end bonds and to bring a bit of stability to the market. So firstly, talking about this particular instance, there's a lot of stories of what led the Bank of England to do this, but I found a good piece by Gary McKay. And what it was it's a little brief thread into mentioning why the Bank of England unleashed its emergency bond buying program. And it was all to do with pension funds. And pension funds, they have an investment strategy called the liability-driven investment, LDI, to ensure that pension funds align with its assets with the way its liabilities are measured as a form of hedging. And, it goes on a bit, but then what happened is that when that mini budget happened and it pushed the yields through the roof, you got a lot of margin calls from these pension funds that were delving into that strategy. And then it got to a point where the falling LDI derivatives have been forced to liquidate liquid assets like long-dated gilts, sending yields spiraling. And we actually had gilts. We talked last week where gilts were about 4%, and it went up to 5%, I think, on the Monday. And then what happened is that the chaos all happened at the long end of the gilt market. The Bank of England had to intervene as part of with its £65 billion bond buying program to avert material risk to UK financial stability. And so what was reported is that there was a run dynamic on pension funds, essentially a wholesale equivalent of the run on which destroyed Northern Rock. And so had the Bank of England not intervened, there would have been mass insolvencies of pension funds by yesterday afternoon, which was basically Tuesday or Monday. Here we go. We got the UK government, Liz Truss, first thing she does, this whole thing, and she almost destroyed the whole UK financial system. So we started off with that. And as soon as we had the Bank of England intervene, it sort of gave a bit of calmness to the market, and we actually reversed what looked like was going to be a really bad day, and then we sort of ended up on the day. So that's how the week started, and it just continued from there. But again, yields came down that day. I think it was 5% in the 30 years. We sort of settled just above 4%. The 2-year, the 3-year, all of those came back quite a bit. And then the market is the classic bond market correlation right now. So when yields go down, stock markets are going up. When yields are going up, stock markets are going down. And then towards the end of the week, we had PCE data out of the US, which came in a bit hotter than expected. We had German inflation, which was above 10%. We had Eurozone inflation, which was above 10%. So all of these inflation numbers just pushed down the markets, and we had yields going through the roof. And so it was, again, an inflation-driven week, which was helped a little bit by the Bank of England actions, but that does not address the inflation issues. But for the UK's sake, it seems like the Bank of England did address its own issues in the country following that very aggressive budget by Liz Truss quasi-quarting last week. And we did have the flash crash in the pound. We actually had the pound Monday morning went to almost parity, 103, which I think is the lowest it's been. I don't exactly know how many years, but it's multiple decades low. And then since then, we have the Bank of England actions have given a bit of calm to the pound, and it sort of ended the week at 111, pretty much where it was prior to the mini budget, but we've got as low as 103. So it's been very wild. That's just one part of this week. What do you say, being in the UK? Like, what's been the reaction in the UK to all of this? Do people even know what's even happening, how close the UK was potentially to a collapse? It just seems wild.
Yeah, it is wild. I think the average person kind of can't make sense on how this is going to affect them. But with the pound being so low, obviously this is going to cause inflation for us, as we're a net importer of goods and services. So it's not looking great for us. Whew, how close we were to disaster. You see that all over the headlines. But I wonder if this is just like the first steps of, like how from the financial crisis back in 2008, the government had to, baby the economy and, put in massive stimulus. Obviously, we're in a phase of removing that right now, but is it the baby throwing the toys out the pram because things are going wrong? And it's like, no, we need all that stimulus back. It seems like, this is just the beginning part of, just the cracks are showing. Rajan, what were you saying about Credit Suisse?
Yeah, so over the weekend, there's been a lot of murmurings about European Investment Bank in trouble, and the name that's been cropping up is Credit Suisse. So looking at some of the murmurings that we've seen, investing.com saying that there's these reports that large investor that deals with Credit Suisse says the investment bank is a disaster. CDSs are trading like Lehman moment, and it's about to hit. And we see so basically the last time Credit Suisse CDSs, credit default swaps, were this high was back in 2008. And since then, we've been in the 50s. We touched a high of 150 just after COVID, but we're trading towards 250 basis points. So it is not looking good. And we saw comments from the CEO saying that the bank is at a critical moment as it prepares for its latest overhaul while stressing the bank stress. So looking at, through trading news, some of the headlines over the weekend, we've seen an ABC Australia correspondent, David Taylor, tweeting that credible sources tell him that major international investment bank is on the brink of collapse. And just on Friday, we actually had the CEO put out a memo to its staff saying Credit Suisse is at a critical moment. I trust you are not confusing our day-to-day stock price performance with the strong capital base and liquidity position of the bank. So the CEO on Friday was trying to put a bit of calm to the employees, giving the impression that they had a strong capital base and strong liquidity position, and the stock price is not reflective of what is going on. But that's exactly what Lehman said just before they collapsed, and Bear Stearns, that's what all these banks say. So the thing is, this week could be the week where the stock market just breaks its back if this event turns into a truthful eventuality. Now, I cannot imagine for the life of me that Switzerland is going to allow Credit Suisse to collapse. They will probably order UBS Bank to take them over, or gather some European banks to shore up the liquidity for Credit Suisse, because Credit Suisse is a huge bank. So, and we look at the share prices below 4 Swiss francs a share. It's getting absolutely crushed. And so this is the new thing that we got to look forward. So if an almost collapse of the UK financial system, pension system, if soaring inflation weren't enough, now we have Credit Suisse enter the fray. And like I said last time, I'm so bearish right now. Everything seems so bearish. And I tell you, this is another thing that now with this, we're very likely to see all the financials open up much lower on Monday. I've got a couple of financials that I think, I'm just going to have to just get rid of them just in case. You never know what's going to happen. Definitely my plan is to go lighten the load this week, because if these banks start to go, and then we saw what happened in the financial crisis, the banks don't lend to each other, rates go through the roof, especially the interbank lending rates, and we could just be on for another 2008, 2009. And I mean, the problem is all these central banks have been indebted to the hill trying to, for all this COVID stimulus. And what do? They're in a quandary because you've got inflation at 10%. Are they going to go back and reduce rates to help the banks while inflation's soaring at 10%? This is just man, this is a tough time, I tell you.
If you look at the central bank's balance sheets, it's negative 3.1 trillion in the last 7 months. So this is showing that we are actually in a lot of trouble here. Are we going to get rescued from this? Or are we just in a world of pain? Now, if you look at the Fed, it looks like they're trying to cut jobs. So that's the real metric that they are after. So it looks like they want to decrease the wealth of the world, because this is kind of like, these dominoes are falling one by one. It's crazy.
I saw this headline that there was, I think, 1,200 or 12. I can't remember the exact number. There was a whole record amount of new millionaires last year, but this year, $9 trillion worth of wealth have been taken out of the US through stock market declines. So there you go. Hand in hand, you had record amount of new millionaires last year, and then you've got the stock market that's knocked out $8 trillion worth of wealth. So there you go. That's what's happening. And like I said to you before, I just don't. They're trying to break the demand, but it's the supply. That's the problem. That's the real problem right here. Get the supply chains back on right. Try to get it all working smoothly again. I think inevitably there'll be a reduction in price, maybe.
But the thing is, if you look at it, Micron and Samsung Semiconductor, I was reading somewhere along the lines that they're kind of cutting their forecast by 30% or something like
Yeah,
that.
yeah.
They're saying there's not enough chips. The supply chains need to sort themselves out. But you look right now, there's already been a destruction in demand, and the companies, especially auto, that are complaining that it is supply chain related issues. It's not the same things that are, were causing issues in the past. It seems like just like a huge amount of demand has been kind of wiped out the market, because even when you look at buying a car, when you could get rates at, say 2%, 3% on financing, and now it looks like, the prime rates are like 7% or something like that on these cars. It's just insane. And just imagine if you don't have an amazing credit rating, you're looking at 10% plus just to finance. So I'm seeing cars going for auction, and they just keep on going back and back and back. They're not selling. It seems like a lot of the sellers are very firm on price, but I don't think they'll be able to do that for much longer. Because they're going to have to, instead of being price setters like they have been in the last year or two, they're going to be price takers. And I still remember in 2008. Do you remember there was that one Porsche that sold for, what was it, like
Oh,
49
yeah,
grand
yeah.
or something like that? Yeah. And it's like there's a lot of these things, especially on Twitter. You see people putting up these deja vu things that are happening, and like feeling quite bearish at the moment. And it's not a really great time to be in the market unless you're a buyer. If you're just kind of holding on, you can see wild swings in your portfolio.
I mean, like you were saying, if we look at the market right now and we look at the S&P, I mean, it's just been since that pretty much. Yeah, we took out the 36 June low that we spoke about last week, and this was the pivot high above 4,300. This was that inflation print which came in hotter than expected, and pretty much since that day, so September 13th, we have literally gone down every day with with about 3 up days in a sea of red, and it just doesn't seem like there's any. This green bar over here is when the Bank of England intervened, and then it just pretty much gave all back the next day, and then afterwards we just went down again. And we've seen strong volume here on all the sell signals, sell bars. Like, I mean, the volume you can see over here is higher than the previous like 2 or 3 months. So there's a lot of volume in these down moves. We went down another 50 handles on Saturday and Friday. So the thing is, we keep on going. I mean, we're now at levels. We're at November 2020 levels. We've taken out the whole 2021 gains, and we're trading at November 2020. So this is where we are now. November. Yeah, we're trading around. Yeah, November 2020. So I mean, where we hit the previous pivot low was back at this level over here, which is just about 3,200. That was reached in October 2020, September, October. So that could be the next level, this bar over here. But in terms of the trend line, we're pushing towards 3,400. And the way which this keeps on going down, $50 at a time, probably going to be hitting it next week. But I'm hoping that this ultra bearish sentiment leads to some type of dead cat bounce. But if Credit Suisse are going to be coming in there, rocking things up, it just does not look good, Yeah.
Ooh, yeah.
Well, let's look on the equity front. We obviously got Tesla numbers, delivery numbers this Saturday. Today, and we had their AI day. So tell us about that.
Well, first of all, obviously, looking at their production, record-breaking 365,900 vehicles were produced, but deliveries, as a percentage, a bit lower than what we expected, or the market was expecting, at 342,800 deliveries. And if we look at Elon Musk's explanation, saying, smoothing out the crazy end of delivery wave to reduce expedite costs and relieve stress on the Tesla team. And that makes sense because, there's obviously all the reports on how much transport services were, they know that Tesla has massive pressure on at the end of the quarter, and their fees are just going up like crazy. And obviously, just a few days after the quarter end, prices all drop. So, if you're a responsible business, what do you want to do? Do you want to keep Wall Street happy, or do you want to lower the cost for the business? So obviously you would do that. And obviously that's what he's saying. Obviously, if Tesla were able to deliver everything that they produce, we'd obviously have like absolutely massive earnings. But I still think that this quarter is going to be it is definitely going to be a record for, free cash flow. And also I think that the average selling prices of pretty much all the Teslas have pretty much peaked now. And I think in EVs in general have peaked, because like Tesla have enough batteries to produce whatever they need right now, but there's still really high demand for their products. So I don't see it coming down like crazy. But I think that right now we're in this bit of limbo period. In the US, beginning of next year, going to be some financial incentives, and same in China as well. So I think that there's a bit of demand kind of being pushed till next year. So I think there is demand for everything that they're making. But again, with this backdrop of macro, uncertainty, financing costs being high, I think it's just going to hit everyone, especially the other automakers. It'll be really interesting to see in the next couple of weeks, how they're faring. Probably going to send.
This is a market
Tesla.
of perfection right now. Like, I mean, in a time where everybody just wants to sell everything, I guess even if this is a very, decent report given the current valuation of Tesla, I mean, I don't know how the market's going to take it, but
I reckon there's probably going to be like a 5% down day tomorrow. But obviously, if you were watching the AI Day presentation, it's just phenomenal what they've actually been able to achieve in just a 6 to 8 month period. Developing this bot. If you saw it and you probably think that, oh, you know what, this is just a walking, waving robot, and can water some plants or something like that. But I think then you're just missing the picture of that. All of the other robots that you've seen, maybe the Boston Dynamics, Atlas, or Spot the Dog or whatever, all the machines that they've got, or these other ones that you see, they're obviously very impressive hardware-wise, but they don't really have a brain. Someone has to control it with a controller, or you have to pre-plan their routes or whatever else it is. Whilst this bot is actually got the self-driving computer in there that Tesla's cars all drive around in, and obviously they've trained the neural nets to be able to navigate the environment as it exists around them. And if nothing's going to really happen in the next year or two, but you're going to see steady development in these robots, and obviously they're using them in the factory to do. It's going to definitely replace jobs, and I can see that probably in the next 1 or 2 years, you're going to be able to have one of these bots, taking over someone in a fast food restaurant or something like that, and you're going to start to see the deflationary forces of robots around. And I think one thing to really think about is that obviously, there has been loads of robots before, but it's the cost of the robots that have been limiting. Obviously, if you look at the Honda Asimo, I think it was like in the late 90s or whatever, they came out with it, and it was obviously walking back then, but they never sold any of those robots. The Boston Dynamics Atlas robot is like $1 million or something like that, or the Spot being 75,000. The thing is, none of them have been really made for production, and that's the real thing, that Tesla's making these things with the hardware is not the most fantastic, but the brains behind it is going to be amazing. So, and you can already see that their progress has just been fantastic. But again, this is very long term. It's not going to move the stock price anytime soon or anything like that. But if you're looking at what other companies really have this kind of like massive TAM on what they're doing, and obviously they're just expanding it all. So I'm not saying buy Tesla right now, but I'm saying that in a few years' time, it's going to be like just seeing their rate of progress and how cheap they'll be able to manufacture these things. It's going to be a really interesting time to be alive to see this. I was very, very impressed.
Yeah, I mean, it's crazy watching Tesla, because sometimes when you see a lot of these presentations, they're by salespeople, well-spoken, spokespeople, but these are just the engineers that their job is engineers, and they're coming out there and just saying, hey, this is what we're doing. It's just like it's not like some big fat sales pitch. It's just like the raw guys behind it coming up and just saying it how it is, and they're very transparent. Tesla, they just lay it all on the line. It's not like they're hiding their biggest project. They just say it out and go, oh, this is what we're doing, and this is how we're doing it. And so it's like quite crazy.
You look at most of the other companies out there, they'll keep everything in hiding until they're ready to kind of show it, and it has to be a polished type of presentation. Well, this is just like, hey, we need the best minds. And the thing is, if you are one of the best minds out there, you would definitely think, well, why wouldn't I want to work with Tesla? Because there's no one else that are moving as fast as them. Like gravity, obviously, the more mass there's around, it kind of circles it. It's the same principle where the smartest minds all want to congregate with the best companies. And it seems like the moment. Anyway, Tesla is that. So, yeah. Again,
So that's another
really
stock.
interesting.
Another stock to look forward to next week. We've got Credit Suisse. We've got the overall financial sector. We got Tesla. I think next week pretty much is the last week, or the 2 weeks. We have 2 weeks remaining before earnings season start again. So we'll now start to see, how Q2 has been for a lot of these banks. So that's going to be on the card. So it's all going to be all kicking off after a couple of weeks. We've got out September, which is historically a really bad month, and this month it really was a really bad month. I don't know if you can see how much did the market go down in September, but it can't have been good. What do you call it? But if you look at where we started September, well, we actually had the initial rally right at the beginning of September, so we were 39.24. We went up to mid 4100s, and then we ended up at 36. So we pretty much dropped around about 10%, just under 10% in September. But from the high in September, we've dropped over 500 points. So about roughly about 12.5%, 13%. So it's not been pretty. But if you actually look at it, we're just slightly below June's low. So I'm really hoping that we can sort of just find some buyers here and even just go sideways for once. Just go sideways. Just do this. Just go sideways. Not. Anyway, but we'll see how it ends up. It's a lot of there could be a lot of catalysts next week. So I'll be looking out, seeing how the futures open. The futures actually going to open the US futures in about just under 3 hours, and we'll see how this news on Credit Suisse actually will be initially interpreted. Because if we're going to have another big down open, you pretty much can see there's going to be a bit of fear in the eyes. And then, I could imagine the Swiss government. If I look about what might happen on Monday, I could imagine the Swiss government talking with Credit Suisse, talking with UBS, talking with other, European banks or US banks or whoever, and trying to, rather than let this go out of control, deal with it before it's even an issue. And UBS comes in and buys up some of these CDS, to shore up the Credit Suisse's balance sheet and take the whole potential collapse off the table. And then straight away they do that, they can avert manic market speculation and a real run on the bank, because the last thing you want is everybody start running into Credit Suisse and pulling their money out, and then that will then cause even more of a panic. It's what happened with Northern Rock back in the UK back in the day. So I would have thought this is what's going to be happening if these rumors are true, that they're in trouble. So that's what I hope they would do anyway.
The thing is, it really depends. The people who have the power, do they want Credit Suisse to go under? Do they want to buy? It seems like, when you had Bear Stearns, when you had Lehman, we had all of these guys, especially Lehman, they didn't need to let it fail. They could have kept it going, right? Just they're bailing out banks left, right, and center just a bit after that. So it really depends. People in power right now, what actions do they want to happen? Do they want the fear to go crazy so they let one bank slide and get acquired or something like that? What are their intentions? This is the thing, because if you look at all of this, it's all happening. Obviously, inflation is high, but the reactions to it, the Fed's reactions and, Bank of England doing all their things, the UK government doing whatever they're doing, it seems like somehow this is all planned. They knew the risk to the gilts and all of that. So
well, you would hope they did.
Yeah, of course. I'm just saying, anyone with a bit of foresight. But I think that there's this concerted effort, like I was saying before, to really get to extract the wealth out of the world, most of the world anyway. So, and it seems like they're succeeding right now. Just who could predict? Yeah.
But do you think it's an elaborate ruse by Putin? Taking down the West, Xi Jinping. This is don't mess with me. We're China, Russia, a liberal. I don't know, but it's who knows what is going on. But one thing we've learned from 08, 09 is that letting the bank go, you look at when you've got an institution the size of Credit Suisse, it's not necessarily what their market cap is, how big their balance sheet, how much intertwinings are there with all these other banks and that. So if that bank goes down, how many other banks will be under pressure? It's the same when you look at just this year when $50 billion valued Luna coin collapsed. Then you just saw after that the cascading effects, like the amount of crypto projects, big projects and hedge funds that all went belly up, exchanges that had massive amounts of Luna and things like that all went down. And so it's not the actual letting Credit Suisse fail, which is going to be the hard bit. If if that is what's happening, it's more about the cascading effects for all the other banks and all the other institutions that are somehow weaved within Credit Suisse. And so,
doubt.
yeah, and
This
that
is
is
it.
where the real
They need the
thing.
fear. If they need the fear, right? This is how you make it happen, right?
Yeah, I mean, last week, what will also be really interesting to see how the ECB rhetoric changed. We had virtually every member of the ECB speaking last week, and every single one of them said repeatedly, inflation is too high. Inflation is too high. We will be doing what we can to bring it down. And the whole mantra is that inflation is the number one problem. But the thing is, I know on the Fed's point of view, is that there's too few job openings. I mean, there's too many job openings, not enough staff to fill it. So that on the labor front, they don't really have the same type of issue. The unemployment rate is still very low. But as soon as you start seeing contagion and bank stress and stuff like that, that is when the whole narrative around we need to tackle inflation will change. Because there's one thing leading the economy into a recession, a mild recession where it doesn't even feel like a recession. Everywhere you go is packed. But then there's like systemic crisis where you're going to have issues from these banks. So
it's really interesting, this tweet. 100 years of history showing that recessions were always able to bring inflation down to less than 2%. But the real question is, how long does it take? And average is about 16 months.
The thing is, getting inflation down to 2%, it's not even an issue whether they'll do it. Of course they're going to do it, because remember what inflation measures is year-on-year change in price. We're at this massive high bar. And then so you're now looking at next year when they say, oh, in 2023, inflation should be below 2%. Of course it's going to be below 2%, because you're going to be comparing it as a 2% rise from today's already mega elevated prices. So of course it's going to be inflation. But the real question is, you need to actually get prices more in line with like 2019. So we actually need deflation to try to make prices at a bearable level. Because the prices now are so high. So if you get 2% inflation next year, you're going to be getting today's price is just 2% higher, which is still excessively high. So I don't think there's any issue about getting inflation down to 2% next year, because it's 2% from today's prices. It's whether, in my opinion, is whether they can get prices down to a level which we were used to in 2019, 2020, or like a more reasonable pricing. For that to happen, we need to have deflation, and deflation ain't a bad thing if it happens off the base that we've got right now. So yeah, so this is so I have no doubt that from today's prices, inflation can come down to 2%. It'll be hard pressed to think that we're going to get 6-7% inflation from the already ridiculous prices we have around the world right now. So we're already seeing like fuel. We've got like I saw 305 here for petrol, which is the lowest I've seen it since like mid 2021. So and all the European countries looking at capping all of these electricity prices over Christmas, over the winter. So yeah, we'll see how it all goes.
So, but if you look at the massive disparity between gas prices, I thought this was an interesting article. Mm-hmm. California gas is more than double what you pay in Texas. Crazy.
Yeah, and I mean, he's on a crusade to still, despite what's going on, he's still on his green crusade, and so their fuel is taxed like it's insanely amount. They're like in New Jersey right now, it's like I said, about 305, 306, and California is in the sixes. This is they've got their agenda, what they want to try to achieve to try to bring it more green. But I don't know. I mean, I guess people in California are just used to it. That's the biggest thing.
Yeah. So now, we're all in this very uncertain time. Is it good to be in the markets or not? What are your plays, Rajan, right now? Do you just think taking something off the table? I know you were saying you are exposed to some.
I took a flyer on Deutsche Bank, and then I will definitely be getting that out. Like, I'm just gonna have to take the hit, because I could imagine Deutsche Bank's gonna be really hit on tomorrow. So I'm just gonna take out that one, because we can clearly see these things can just go to zero. It's difficult, in this time, given the market and how much it's all off, to just get out of everything. But the main thing is just stay really small. Like, I'm not going to take any big bets. Just like edge in with tiny little positions with whatever I got, or maybe not. And it's a very difficult thing, because the thing is that I saw it again. You look at all the stats, and after Bear Stearns went down, I think we actually rallied 17% after the collapse of Bear Stearns. And so we are very, very oversold right now. And so I do think we can get those rallies. And like I've said to you before, on every rally, I'll be just taking bits off. That's it. Just trim like 5% off across the board, like across everything. Just do like a blanket sweep. Bits like that here and there, just to keep a bit of cash. And again, if we just continue rallying, then then that's how it works, and then it's fine. You still got your portfolio, but it's about, it's just so hard to call. But all the points, all the signs, everything that's going on just point to more downside. And
so it just all depends. Now, will the Fed change their stance, because it seems like they're the only ones that can kind of shift things to like a more bullish kind of long-term trajectory, or the market has to feel like things have hit a bottom. And it's really difficult to know when that is, because I think the only real main catalyst that would push markets up, at least temporarily, or in the very short term, is the war ending or something like that.
What it is, look, why do markets rally? If you look at every rally, it's on easing policy. And so if the narrative changes and the Fed dials back, like, why is the market crashing? Well, not crashing, but just on its constant downside, because we're seeing consistent bank rhetoric that inflation is too high, another 75 basis points. Where is the terminal end? Where's interest rates getting to? Markets start seeing a shift in language that they may ease down on the rate of rate increases. That is when the market will rally, because market loves times where tightening is starting to loosen. And that is basically what we're looking for. So if all of this stuff happens, and then the banks start easing off in their rhetoric, so hawkish in their rate stance, then I reckon we could get like a bit of respite. It might not be long term, but at least short term, we can get a bit of respite. So if this Credit Suisse thing is true, and the bank positions changes, I think we can get something. If you like what you heard in this pod, please give a like. Subscribe will be great. And we'll catch you on the next one. And hopefully we'll have a better market scenario than we do right now.